Good morning, everyone, and welcome to Tuesday morning. It's Stephen Whiteside here from theuptrend.com. In the pre-market this morning, stock index futures are above fair value while commodities are mixed. We've got gold higher while crude oil is trading lower on Tuesday morning. Well, yesterday the markets were down for the most part, but there were a couple of bright spots, and we had NVIDIA moving back up to the August highs. And the best performing stock on the NASDAQ 100 was Supermicro, which was up over 15% on the day, so back on a daily buy signal. It's continuing to move higher in the pre-market this morning, so a couple of chip stocks really holding the market up. Now, in the pre-market this morning, we do have Chinese stocks trading lower. The FXI ETF is currently down 10%, so a little profit taking there in the Chinese market. The USO was higher yesterday. It's down a little in the pre-market this morning. We had natural gas roll over back on a sell signal as of Monday's close. The GLD was down slightly yesterday. It is up in the pre-market this morning. The SLV was down yesterday. It is up in the pre-market this morning. Looking at the VIX for the S&P 500 moved higher yesterday. Of course, that's negative for stocks. We're not really seeing that at the moment. We did see all the major indices trade down to the lower channel line yesterday. So there's the Dow, the S&P 500, the equal-weighted S&P 500. There's the NASDAQ 100, the equal-weighted NASDAQ, all trading down to the lower channel line, none closing below it on Monday. There's the next generation NASDAQ stocks down on the day, but closing at the upper channel line. The Russell 2000 was down a little over 0.75% yesterday, still on a sell signal, no change there. Barely any movement in the semiconductor ETF, even with NVIDIA and Supermicro moving up. Looking at the Canadian market, we had a small pullback in the iShares for the TSX 60 and the Vanguard Canada ETF. No trend change there. Now, yesterday we were praising the U.S. insurance sector for moving up and moving the financials higher. Yesterday, the sector rolled over, and Everest was the big loser on the S&P 500, down just under 8.5%. Progressive was down on the day as well, already on a sell signal. So obviously, the insurance industry is taking the next storm a lot more seriously than they did the previous one. Of course, this storm is heading towards more densely populated areas, and I would imagine homes that are much more expensive than some of the homes that were destroyed in the last storm. So the insurance sector rolling over on Monday. Looking at Canadian financials, they're still holding up, closing at the upper channel line. Now, the Canadian energy sector continued to move higher, as did the U.S. energy sector. And again, Canadian energy stocks outpacing U.S. energy stocks on a percentage basis. Then looking at the gold sector, gold stocks were down on both sides of the border, so no trend change there. Next up, let's take a look at our 31 stocks in 31 days. And of course, these are not recommendations. We're just randomly going through the database, picking stocks that people may be familiar with, and looking at how the charts look for those individual stocks. When we go through the list of the stocks we've already covered, one trend change, and that was Apple generating a sell signal as of yesterday's close. So if you're long Apple, you want to be a seller at the open on Tuesday morning. Boeing traded up through the upper channel line yesterday, sitting right on the edge, just 31 cents away from a new daily buy signal. No change for Chipotle. It generated a sell signal last week. We waved it off, looking for the next close below the lower channel line to confirm that sell signal. That hasn't happened yet. There's Canadian Natural Resources heading up and hit our next price target. So cha-ching. Hopefully you got rid of 50% of your position yesterday and locked in profits up at $50. As you can see, looking to the left, $50 has been a major area of resistance for this stock. If we can take out the August highs, then 53.13 certainly comes into play. With the pullback in crude oil this morning, I'm not expecting that to happen on Tuesday. Looking at Dollar General and Dollar Tree, no change there, and no change for Dollarama, and certainly no change for Etsy based on Monday's trading action. Today's stock is FedEx, and FedEx isn't doing well at the moment. On the weekly chart, we're currently ranked a 3 on a scale of 0 to 10. On the daily chart, we're ranked a 1 on a scale of 0 to 10, so the stock's not doing well at the moment. Chart is worth 1,000 words, and of course, our charts are color-coded. Blue is bullish, red is bearish. Some stocks shout, leave me alone, and FedEx might be one of those stocks. You wouldn't say that by looking at the monthly chart. We've been on a monthly buy signal since early 2023, and we ran up and failed to retest or take out the high from 2021, so that's a bearish sign. We've pulled back over the past couple of months. We are looking for a close at the end of this month at below $254.13. If that were to happen, that would give us a monthly sell signal, joining UPS, which has been on a monthly sell signal since the start of 2022. So obviously FedEx is way outperforming UPS at the moment, and that's been going on for quite a while. Now, if we look at the weekly flypaper channel chart, you can see that the market has been willing to buy the dips, and the flypaper channel is still pointing higher. You can see that the market is using the moving averages as support. That looks pretty good. Hitting our price targets, that looks good. 281.25. We hit it a couple of times, then pulled back. You got to lock in profits. We hit 312.50 back in the summer. Congratulations, you got to lock in some profits there. Now, here's the problem is since late 2023, things have been very choppy, and you don't see everything that goes on by looking at the weekly charts. You got to drill down a little more. We'll get out of the weekly charts, look at the daily charts, and you can see that there's been a lot of gaps in 2024, and that's not a good sign. Now, it is certainly nice to think that, hey, I bought back here, it gapped higher, congratulations. I bought here when it turned blue, and it gapped higher, congratulations. Then you can see it gapped lower here, and it gapped way lower over here. Gaps are a sign of, there's no agreement. The market only works if there's an agreement between buyers and sellers. Here's points where there was no agreement, and it's usually caused by a surprise from the company. Right now you can see that the company and the market are not in sync. There are surprises to the upside and to the downside, and that's not a good sign. That's not something you want to be investing in or trying to trade if the company isn't properly setting the stock market's expectations and surprising them. That is my point here, is that, when I look at a chart like this, or I look at a chart from companies that trade overseas, you're going to see a lot of gaps. When you're taking on a symbol that has a lot of gaps in it, you're taking on additional risk because the gaps tell you right away that the market and the company are totally out of sync with each other. We've broken down below the moving averages, so the 200-day moving average is probably going to act as resistance on the way up. Looking at the daily right side chart, you can see we would generate a buy signal today if FedEx were to close above $271.30. That's not likely to happen, and that upper channel line is going to continue to move lower daily. We're down at the bottom of the panic zones. A pressure zone has formed. We were trying to get liftoff from this particular move back up to try to fill the open gap, and it failed, so that's not a good sign going forward. You can see we came down and filled this gap over here. That gap is no longer in play. This gap still could be in play, but you don't care about gaps above you when you're moving lower, and when you're moving higher, you don't care about the gaps behind you. So right now we're in a situation where the stock is looking pretty weak, and we'll probably go back down and test the lows from earlier in 2024. So that's all for today's presentation. When you're looking at charts, look for smoother more than rough. When you're looking at a chart which has lots of open gaps, it's probably not a good thing. The company is out of sync with the investing community, and that's not what you want. It's a lot easier to make money when the company and the market are in sync, and that is certainly not the case for FedEx. Okay, folks, enjoy the rest of your day. Next time you'll hear my voice is on Wednesday morning.